Is your portfolio ready for a world where the Strait of Hormuz shuts down? Because if it does, we're not just talking about headlines anymore. We're talking about a global economic shock. Oil prices could surge, food prices could spike, and supply chains could break almost overnight. In this video, I'm looking past the politics and breaking down exactly how this conflict could reshape the commodities you depend on and what a borderless investor should do right now. Welcome back to The Borderless Investor, where we simplify global investing so you can build wealth even when the world feels uncertain. This isn't just a regional conflict, it's a potential global supply chain disruption. Today, we're covering the following: the energy choke point and the $200 oil scenario, the surprising battle between gold and the US dollar, the hidden impact on food and fertilizer, and how to protect your global portfolio. The energy choke point. Let's start with the center of it all, the Strait of Hormuz. This narrow passage handles roughly 20% of the world's oil trade. If it were disrupted, even temporarily, millions of barrels per day could be affected. That would make it one of the most significant supply shocks in decades, and we've already seen how sensitive markets are. Oil prices have previously spiked sharply during periods of tension in this region. If a prolonged disruption were to happen, some analysts suggest oil could move toward $150 or even $200 per barrel. And this doesn't just affect fuel, it acts like a hidden tax on the entire global economy. Transport gets more expensive, manufacturing costs rise, and consumers feel it everywhere. Investor takeaway: if you're heavily exposed to consumer or transport sectors, you're likely to feel pressure first. Before we get into the most overlooked part of this crisis, if you're finding this useful, consider subscribing. Most people watch but don't subscribe. And if you want more clear breakdowns like this, you don't want to miss what's coming next. Safe haven battle, gold versus USD. In times of crisis, investors usually rush to gold. But this situation is more complex. As energy prices rise, countries need more US dollars to pay for oil imports. This strengthens the global demand for the dollar. Combine that with higher interest rates, and suddenly, the US dollar becomes a super haven. This creates a rare situation where liquidity matters more than tradition. Gold may not surge immediately because capital flows first into cash and dollar-based assets. Strategy: don't ignore gold. Historically, it tends to recover after the initial shock, but in the early phase of a crisis like this, holding cash in strong currencies can act as a buffer. The hidden impact: fertilizer and food. Here's what most investors overlook: fertilizer. A significant portion of global fertilizer production and distribution is tied to regions affected by energy prices and geopolitical tension. And here's the key connection: fertilizer depends heavily on natural gas. So when energy prices rise, fertilizer costs rise with them. And when fertilizer gets expensive, food is next. This creates a second wave of inflation, one that hits every household. What to watch: producers outside high-risk regions, including those in places like Canada, can benefit when global supply tightens. Portfolio defense. So how do you apply this as a global investor? First, stay diversified. If you already hold global ETFs like Vanguard Total World Stock ETF or Vanguard FTSE All World UCITS ETF, you already have exposure to energy and commodities. But you can make small adjustments. 1. Energy hedge. Consider a modest tilt toward energy-focused assets to offset rising living costs. 2. Geographic balance. Markets with strong exposure to commodities, like the UK or resource-heavy economies, can sometimes perform better in these environments. 3. Bond caution. If inflation rises due to energy shocks, central banks like the Federal Reserve may keep interest rates higher for longer. That puts pressure on long-term bonds. You don't need to predict the crisis, you just need to survive it. The best portfolio isn't the one that predicts the next war. It's the one that's built to handle uncertainty. Stay diversified, keep your cash buffer, and don't let short-term headlines push you into long-term mistakes. Because in global investing, discipline beats prediction. If this helped, please subscribe to the channel, and next, we'll dig deeper into the main commodities and how they react with international conflicts. Build wealth. Stay borderless. I'll see you in the next one.